Hello, and welcome to Aldrich Wealth's first quarter 2017 investor update. I'm Nicole Rice, director at Aldrich Wealth, and I'm joined by Darren Richards, our chief investment officer and partner at Aldrich Wealth. Darren, can you give us an update as to what fourth quarter 2016 looked like?
Sure, Nicole. Thank you. The quarter was really divided into two distinct periods. There were the 5 weeks leading up to the presidential elections and the 7 weeks after the elections. In the 5 weeks leading up to the elections, investors basically were on the sidelines waiting. Not a lot of new money, trading volume was low, and sellers were met with reluctant buyers. So we saw equity prices in general decline. Small cap stocks were the worst performing asset class. At the same time, we saw some economic strength in the market. So investors began to price in the probability that the Fed would hike rates in December. So that happened, and we saw interest rates move higher, bond prices move lower. So for the first 5 weeks, whether you were in stocks or bonds, returns were negative for the quarter. So it was a very difficult period. Following the rather surprise victory on November 8th by Mr. Trump, the market repriced in risk. So we took a look at the policies that Trump presented, which included lower taxes, both corporate and individual, less regulation, and increased infrastructure and defense spending. And the market then repriced these in. What we saw were the areas of the market that benefited most from Mr. Trump's policies rebounded strongly. Number one, financials. Financials were up over 20% in the quarter. That was primarily because interest rates were expected to rise. We were going to see less regulation. And at the same time, the economy looked like it was going to strengthen. So perfect environment for financials. The other two sectors that performed well were energy. And this was, again, primarily based on less regulation, potential for more drilling opportunities in the future. And the last sector was industrials. And this was on the back of increased infrastructure spending that was expected to help this sector. At the same time, there were several sectors that performed quite poorly during the quarter. These were generally interest rate sensitive sectors. So we saw REITs, real estate investment trusts, drop in the quarter. We saw utilities stumble, and then we saw consumer staples, which is a very defensive sector, pull back. So we had the haves and the have-nots during the quarter. Unfortunately, on the international side, performance was not good. The U.S. dollar strengthened 5 to 6% versus the euro and the pound, and over 15% versus the yen. So it was quite a headwind for international stocks. At the same time, Mr. Trump's kind of tough talk on trade, say that 3 times, really pulled investors away from the international markets. We saw quite a dramatic pullback in our major trading partners, Canada and Mexico, and to some extent China. So a difficult environment for international equities. On the fixed income side, interest rates increased during the quarter. They rose during October, and they rose dramatically in November after Trump won the presidency. What this did was push bond prices down. So fixed income investors had an extremely difficult environment in the quarter where bond prices generally declined. Overall, if you look at the market, we saw roughly a 4% increase in the S&P 500, so fairly good for U.S. stocks. We saw about a 3% pullback in bond indices, one of the worst performance in over a decade, and we saw slightly negative returns for international equities. So a very diversified portfolio, included stocks and bonds, actually had a difficult time eking out a positive return for the quarter. Going forward, we continue to expect interest rates to rise. We think that's going to continue. We think economic growth, both U.S. and globally, will pick up. And we also think we're going to see less regulation in the U.S. So based on that, we've made some changes in 2017. First of all, we've increased exposure to equity versus bonds. Again, we think interest rates are going to rise. That's going to be a difficult environment for bonds, and we think economic growth overseas and the U.S. is going to pick up. So we think the stocks make more sense over bonds right now. On the fixed income side, we've cut exposure to bonds, but we've increased exposure to floating rate bonds. Floating rate bonds perform better when interest rates rise. These are bonds whose interest rate is attached to the floating rate versus a fixed rate. So when interest rates move higher, bondholders actually get more in return. So it's a very good environment for that type of investment. And lastly, we've increased exposure to financials. Again, we think financials have room to run. We haven't seen any regulation improvement right now, but just the fact that interest rates are increasing and the global outlook is improving is a great environment for financials, which frankly never recovered from the recession. So we're very positive on these spaces. And going forward, this is what our portfolios look like.
That's great. Thank you, Darren. And thank you for joining us for our first quarter 2017 investor update. Hope to see you soon.